Hello, everybody, and welcome. This is another intermediate accounting video for your fun and pleasure. We're going to be going over today, it's interest capitalization, which is in the Wiley 18th edition of Keystone Weingan. It's their chapter 9, 17th edition is their chapter 10. So my disclaimer and copyright note is the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University at Fullerton. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This video is meant to be a companion to the 18th edition of Intermediate Accounting by authors Don Kiso, Jerry Weingan, and Terry Warfield, copyright 2022 by Wiley. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're not going to actually use Wiley's exercises and problems. I thought I would, but I wanted to choose something else. So I made it my own, went with Walter and Jesse to New Mexico, got to know Winnebago and made that blue magic just for you. I'm just kidding. Now, what is the theory behind interest capitalization? Like, what is this all about? Well, if we are self-constructing assets, there is a cost of funds, right? We're using money to self-construct these assets, and therefore that interest amount that relates to those expenditures while we're going through isn't really interest expense. It's really a cost of that asset. So what we're essentially going through and doing is we are reclassifying interest expense to the asset that we're going through and self-constructing. So this is a great, if we click on this link right over here, which I will include down below. This is from PricewaterhouseCoopers, right? This is their little book right over here, their viewpoint, great thing. Accounting, ASC, accounting standards, codification. Gotta love those acronyms. So as noted in ASC. So what I'm showing you right over here is really coming from PwC's manual, which I'm giving them credit for, so it's awesome. So right over here, so interest needs to be capitalized for the following types of assets. So assets that are constructed or produced for an entity's own use, including assets constructed or produced for the entity by others for which deposits or progress payments have been made. Assets intended for sale or lease that are constructed or otherwise produced as discrete projects. And then you get down in here into this funkier one, which are investments. So if we're self-constructing an asset or we're paying someone to go through and do it, that's when we have to go through and capitalize interest. Now, for this one right over here, we're not going to capitalize interest for the following things. Now, the one I want to really point out to you are inventory. So if we're making inventory that are routinely manufactured or otherwise produced, meaning our normal business operations, we're not going to go through and capitalize interest for that. So that's really, as we go through and look at this, that's what you would be doing is, as you're working as an accountant, these are the kinds of things you would kind of be going through and saying, okay, is it right for the client or us as management should we be going through and capitalizing interest? When we're going through and looking at interest capitalization, the first thing we're going to do on these problems, though, is we're going to say, okay, what is the weighted average amount of expenditures that we're spending during the year, right? And in terms of going through and looking at this, if I'm spending dollars in March, that's going to be different than dollars spent in November. Why? Because the amount of time that expenditure took place in March, those dollars were outstanding for 10 months, whereas in November it was for only 2 months. So we're going to go through and first determine the weighted average accumulated construction expenditures. Once we do that, the next step is going to be saying, okay, do we have any debt that is specific to the construction? If we do, we're going to go ahead and capitalize that amount with using that weighted average construction expenditures. If there's anything left over, meaning that, say, if we had 5 million of debt, or we have if we say we had 5 million of weighted average construction expenditures, and say we had 1 million of construction specific debt, then we have to go through and say, well, we've applied that rate to that 1 million. But what about the other $4 million? So that other $4 million is really kind of going to be more of a function of, well, what other debt do we have outstanding? So let's go ahead, instead of me yapping, let's go through and look at an example. Okay, so we have a couple of construction, expenditures put right over here. And let's go through over here. So we began construction on a new building on land that was previously purchased in the state of Nevada, because you never get this kind of construction through that quickly in California. The cost of the new building was estimated to be $10 million and had the following payments made during 2027. And the building was ready by 1/1/28. Vegas, it's quick, stays in Vegas. YYZ had the following debt outstanding. So we had specific construction debt for 1.5 million. We had non-specific debt over here of 10 million, non-specific debt of 5 million, and assume that the asset qualifies for interest capitalization. So what do we know? Well, the amount of interest that we're paying during the year, right? So during 2027, and assuming that interest is being paid annually, so I'm paying 1.5, I have 1.5 million, and this is at 6%. And also this loan was only outstanding right over here. We borrowed the money on 2/1, and if I'm paying it on December 31st, I'm going to have to multiply that amount by 11/12, right? Because it's February, March, April, May, June, July, August, September, October, November, December, right? So we've got 11 months. So the amount of interest that I'm paying over here for this 1.5 million is going to be 82,500. Right? Because again, this is the amount of, I'm just going through right here. I'm just kind of reviewing, this is the amount of interest that I'm actually going through and actually paying, right? So right over here, I'm going to be paying, this is 1.5 million times 6%, which is the annual interest rate, right? So this is the construction specific indebtedness times 11/12. Why 11/12? It's from 2/1 through 12/31. So that's our first one right over here. So I'm just trying to figure out first, how much are we actually paying in interest? I come over here, I borrowed $10 million, right? And my annual interest rate was at 9%. And this was outstanding for the entire year because I borrowed the money on 1/1/26. So this is going to be 12/12. So 10 million times 9% is going to be $900,000. Okay, then I also had over here 5 million at over here at 10%. And this is also going to be 12/12 because this is dated 1/1/25. And this over here is at 0.1 or 500,000, or excuse me, yeah, 500. No, that's 50 million, a little bit too much. Okay, so we've got 500,000. So the total cash paid for interest during the year is going to be 1,042,500. Now, what I'm really trying to go through and to figure out is like, okay, if this is the amount of interest that I paid during the year, how much of this has to be capitalized? Meaning how much of this relates to our construction? So the first thing I need to do is to figure out, of these payments that I've gone through and made, how long were these things outstanding for during the year in question? So as I'm looking at this over here in terms of looking at all these amounts that were paid, and this kind of goes to what I was saying a little bit before, 500,000, this is different than 2.3 million paid on December 31st. Why? This was outstanding for like a day, and this was for a full 12 months, right? So the money was outstanding longer. So over here, I'm going to multiply this by 12/12 because it was outstanding for all 12 months out of the year, or times 1. Now this 3 million, I basically made the payment over here on March 1st. So for this one over here on March 1st for 3 million, I'm going to multiply this by 10/12. Where am I getting 10/12 from? March, April, May, June, July, August, September, October, November, December. So I got 10 months right over here. So over here, I've got 3 million times 10/12. I got 2.5 million. Over here, this 3 million, well, this is outstanding for 7/12, right? We've got June, July, August, September, October, November, December, right, for 7 months. So this is going to be 3 million times 7/12, or 1.75 million. Over here on August 1st, this 1.2 million, this is outstanding for 5/12, August, September, October, November, December. So 5 right over there. And then this is going to, we'll call this 0/12 because it really wasn't outstanding for a full month, right? So over here, we'll go ahead and do 5/12. So we got 1.2 million times 5 divided by 12, or 500,000. So even though I spent, right, a total over here, I spent a total of $10 million, my weighted average construction expenditures is going to be $5,250,000. Why is it like that? Well, this $5,250,000, this is really kind of going through and saying, well, hey, the amounts I'm spending at different points in the year, they weren't outstanding for that full period of time. So really what I'm doing is I'm coming up with a weighted average. So now that we have our weighted average construction expenditures, I'm now ready to say, okay, what amount of interest do I use for this $5,250,000? Well, for the $5,250,000, which is going to be my weighted average, right? So right over here, this is my weighted average construction expenditures. Okay, so this right over here is $5,250,000. The first thing I'm going to need to go through and do is say, okay, what construction specific indebtedness do I have? Well, I took out over here, I've got 1.5 million, right? So in terms of capitalizing interest, the interest that relates to this 1.5 million is going to go ahead and be immediately capitalized, right? So this is going to be capitalized at 82,500. So this is the construction specific debt. And this over here is going to be 82,500. So right over here, the amount of this, basically, this will be, so this here will be 82,500, right? So that's going to be my first part right over here. Okay, now, and as I'm looking at this right now, I'm actually going to change something up, and I don't want to be a jerk about it, but I'm going to change something up. And yeah, I want to change this up. I'm going to actually change this to be 1127. It's not because Elmo is afraid. It's just going to be because this is going to make this a lot cleaner. Okay. And this will be the principal amount will be repaid on, I'll say 12/31/30. Okay. So it makes it just a little bit easier for us. Okay. So this over here is going to be 82,500. So now when I look at this over here, the amount of my weighted average construction expenditures outside of, I should say, beyond the construction specific debt. And if we look at this over here, this is also now going to be 12/12 or 90,000. Okay. Okay. So right over here, my construction specific debt that relates to this is going to be $90,000. Now, when I come down to this part over here, the 3,750,000, what I now have to kind of go through and do is say, okay, so we've already went through, we've kind of allocated this. Remember, we allocate this construction specific debt first when we're going through and doing interest capitalization. We know that we're paying 1.49 million in interest. What our question is, though, well, how much of this amount should be capitalized for the construction costs? So as I look at this over here, what I kind of go through and say, well, what is the interest rate that I should be applying to this 3,750,000? I applied the 6% because that was specific to the construction. When I'm looking at this over here, well, what interest rate should I be going through and applying for this 3,750,000, right? How much, like what interest rate should I use? So in order for us to kind of go through and do that, what we need to figure out as well, what is the actual average interest rate that we're going through and paying? Well, the amount of the debt that we have, the amount of the non-specific construction debt we have is over here at 15 million. the amount of the interest related to the non-specific construction debt is going to be over here at 900,000 plus 500,000 or 1.4 million. So my average interest, right? So when I'm taking the total amount of interest that I'm paying divided by the amount of the debt, when I go through and do this, I get a nice round 9.33%. And let's think about this. Why does that kind of make sense? Well, if I have 10 million at 9% and I've got 5 million at 10%, the interest rate in terms of being a weighted average that I need to go through and apply to this should really be between these two values. And it should be kind of heading down more towards this 10 million, mainly because, well, why is it heading towards the 10 million? Is because this is at 9 and the 5 million is at 10. So it's at 9.33. So it's a little bit more weighted down here to the 10 million. So what I'm now going to do is I've said, okay, this 1.5 is at 6%. So that's what I go through and capitalize first. Now for this for the weighted average that's beyond the construction specific debt of this 3.75 million, I'm going to go ahead and say, all right, 3.75 million at 9.33%. This is going to be giving me over here 350,000. And obviously, because I'm using Excel, the numbers are nice and round. And for those that are taking me, hopefully you'll kind of go through and see this on a test. So the total amount of interest I'm going to go through and capitalize is going to be what? Well, it's going to be, I have to capitalize weighted at annual average construction expenditures of 5.25 million, totaling right over here. I've got 90,000 bucks from the 1.5 million. This is the one that I went through and changed. It's basically construction specific. So that's what I allocate first. So I've got this part right over here. Then I have to say, well, what's remaining, right? The 5,250,000 minus the 1.5 million or 3,750,000. What do I use for this one? Well, I look at the non-specific construction related debt and I need to say, well, what's the average interest rate of this? So if I take this, the amount of interest that's being paid of 1.4 million, and then I've got the total amount of the debt of 15 million, that's giving me a rate of 9.33%. So that's what I'm going to go through and apply. So the amount of interest to be capitalized is going to be a total of 440,000. So if I'm asked to go through and to prepare a journal entry for this, what is it that I'm going to go through and do? Well, over here, I know that I'm paying cash on 12/31/27. I know that I'm going to go through and pay cash of 1,490,000, right? That's the amount I'm going through and paying. Cash is being paid for interest, right? It's 1.49 million. I'm going to capitalize basically to construction in progress. My construction in progress, I'm going to go ahead and capitalize this for 440,000, right? So where does that leave me with a journal entry? Well, what do I need to go through and balance? I think it's going to be 1,050,000. Let's see if that works. And boy, oh boy, does that work. Okay, so right over here, I've got 1,050,000. Okay, so this is going to be to interest expense, right? And this would be over here is to go to capitalize, to record interest expense, capitalize interest. So if I look at over here, I've got my date, account, debit, credit, right? So when I'm looking at this over here, that's how I go through and capitalize interest. So let's just kind of take a look at it again, right? So I went through and I spent this money during the year, right? Dollars that I spent in March are different than dollars I spent in August, right? So I first have to go through and say, well, what is my weighted average construction expenditures? We came up with 5.25 million. That's going to be the amount that's going to be subject to interest capitalization. Once I figure that amount out, what I'm then going to do is say, okay, What's the construction specific debt? Well, we had 1.5 million that I changed midway through. I guess I can do that. Probably not the best thing to do. Probably should remake this video, but yeah, what are you going to do? Right over here, this is out for the entire year. So I've got over here, this amount is going to be at 6%, or right over here at 1.5 million at 6%. So that amount is going to be immediately capitalized because it's construction specific debt. But after I go through the construction specific debt, I have this 3.75 million in weighted average construction expenditures that I don't know what to do with it. So what do I need to do? I need to look at the non-construction related debt, and I've got two of them. I've got a note over here, both 8-year, 6-year notes at different percentage rates. So what I'm going to go ahead and do is I'm going to basically compute what the interest is in total that I would be paying for the year. To determine the weighted average, I'm going to total up those interest payments. I'm going to divide it by the amount of the notes. I'm going to come up with an average rate. This rate kind of makes sense because the majority of the outstanding debt is at 9%. And, this over here is at 10. And so it's going to kind of trend downwards towards that 9, but will be between 9 and 10. I then apply this amount to the 3,750,000. I get 350,000 plus the 90,000 tells me the amount of interest that I need to go through and capitalize. I go ahead and do this entry right over here. Boom, I am done. So I will basically make this available to you. So you can basically have this right over here to kind of go back and refer to as you're going through and doing these questions. I want to thank PwC for, well, I'm using their material, but I'm also promoting them as well. It's great stuff. And I want to thank you for joining me here today. Please do not forget to like and subscribe to the channel. If you have any questions, please feel free to email me at 1812cpa@gmail.com. Have a great rest of your day, and I look forward to seeing you on the next video. Have a good one.